Welcome to this week's On the Spot. I'm Zach Strickland, here with, as always, John Paul Hampstead, our Director of Passport Research at FreightWaves. And a lot is happening right now. So we just got a huge jobs report. The economy appears to be in some form of recovery, but your team has actually produced some fascinating research on what to expect from the consumer, because the consumer is really what drives a lot of the economic recovery. That's going to be the focal point of what drives, what happens in freight eventually down the line. Industrial economy depends on a lot of this consumption activity. What is your team found?
Well, first, Zachary, I just want to say that I think the unemployment data that came out today, the jobs report, is probably the biggest surprise in the history of this rate.
It goes to show you. It goes to show you how little we all know about what to expect.
We were at 14.7% unemployment. And as of yesterday, economists were saying we're going to approach 20%. Well, it went down to 13.3%. So we cut 140 basis points of unemployment, in the country. Had the biggest job growth number ever, which makes sense given how many people were laid off and all that kind of thing. But it's obviously a really exciting number, a huge moment for the country when we realize hopefully the worst is behind us. Hopefully this recovery will be faster than we thought. As far as my team's research, which we published last night, and we'll talk about it on a webinar this afternoon for Passport members, we basically were asking ourselves the basic question: how can truckload volumes be up when consumer spending is down? Right. And then, so there are a number of factors that dilute any kind of one-to-one correspondence between consumer spending and truckload volumes. The first, obviously, is that a lot of consumer spending is for services, not goods, right? Even retail spending was down. So how can truckload volumes be up when retail spending is down? Well, a lot of that has to do with there being a mix shift in retail spending, right? So, people, didn't go to department stores, but instead they spent money at, discount stores and wholesale clubs and grocery stores and hardware stores. They weren't necessarily buying clothes. And so there's the type of goods people were buying was changing. And then the last thing I just want to say is that there's a very elastic relationship between the amount of dollars being spent and the actual number of truckloads it takes to move the goods associated with that spend. So just using a grocery example, if I want to save money at my weekly trip to the grocery store, maybe I don't buy the cage-free eggs, maybe I buy the normal, cheapest eggs you can get, right? Well, it still takes the same amount of truckload capacity to move those eggs, even though they cost far more than there's a far more than 10% discount or whatever. So it's a very indirect relationship. What we did in our report is we kind of looked at the history of truckload carrier earnings, history of truckload carrier operating ratio, put that over retail sales, kind of looked at places where retail sales were really weak, saw how truckload carriers did. Turns out, as we know, there's a capacity cycle in truckload that really is what drives earnings. But then we looked at kind of the current state of retail spending and some of those dislocations I was telling you about, the shift in consumer spending from services to goods, from department stores to discount stores, from restaurants to grocery. A lot of that is starting to come back the other way.
Right.
So at one point, grocery was 70% up year over year in terms of spending. Now it's 23%. So it's still hugely outperforming. But a lot of like I said, a lot of the dislocation and the disruption and the has started to normalize again. So restaurant spending is still climbing out of a deep hole. It's still down double digits, but it was down 80%.
Right.
So it's like things are starting to revert back to normal, starting to normalize. There are a couple of categories, obviously, where that hasn't happened: airlines, movie theaters, different kinds of sporting events, concerts, things like that people aren't spending any money on. But what's interesting is that people spent the money in other places, and a lot of that benefited freight. And to say that the spending is pulling back doesn't necessarily mean that freight volumes are going to suddenly collapse or anything like that. It just means that transportation companies are going to have to think about their portfolio mix of customers. If you're exposed to big retailers, you're probably sitting pretty right now. Like those volumes are probably growing.
Yeah, like the Walmarts and Targets, and then of course the home improvement sector.
Walmart's, Targets, but even the places like in the mall. Right,
really?
like those places are growing now, and those places are still negative year over year, but have a lot. So they have a lot of room to run up going forward.
So Anthony Smith and I discussed on Freightonomics this week, our weekly podcast, about how there appears to be at least this impact of turning the engine back on, or turning everything back on. There's kind of a bump in activity as everybody comes back to the office and gets things going again. And again, at the retail sector, people have been cooped up for a while. Maybe they're going out and, they finally get to go to the store they've been waiting to go to for a while, and they have this, pent up energy that they're willing to spend on. And, we saw it in the credit card data that your team analyzed a few weeks ago, where everything, like you were saying, is kind of reverting back to the mean. We're going back to the seasonality, and I think the real question is how close to that reality, that pre-COVID reality, do we get to?
Right,
Yeah.
right. Because there's so many restaurants that that may have closed permanently. I know that the Senate just made some modifications to PPP, which should free up a lot more money and make it a little bit more flexible for small business owners to access that capital. So hopefully, like, a lot of the businesses that aren't closed permanently. Another data set that we looked at that I think is super fascinating is there's also a big difference between total category spending. So like, how much money are people spending at restaurants as a category versus average daily revenue at restaurants that have remained open, right? So, half the restaurants in the country close. Restaurant spending goes down a lot, but the ones that stayed open are making a ton of money,
right?
Because people look on their phone, or they're Googling, or they're trying to figure out which restaurants. If they want to go to a restaurant tonight, honey, our favorite 3 places are closed. What about this place? Let's go here. You go there, it's packed.
Yeah, no, I mean, to me, I've always looked for the eye test, and going out the last couple of weeks, I've still been out in the world, going back and forth to the office every day, but going out the last couple of weeks, the restaurant situation, there's waits. Yeah. Again, it's not like we've really even though they're spacing people a little bit, differently now, but there's waits. We were even turned down last weekend at restaurants saying we were at our quota for the day, and I was like,
good for you. Yeah,
so, I mean,
great. As far as freight markets go, I think this week started off pretty level with last week, the way last week ended, which is strong. Even capacity in terms of tender rejections, pretty flat compared to the end of last week. So 5.29% rejections, which are low, but moving in the right direction in terms of getting the spot market eventually back to where it needs to be. I mean, we need to get tender rejections to like 7 to 10%.
Before we see any, I think the interesting aspect to the tender rejection rate right now is the fact that it's very disconnected from the volumes, in the way that it doesn't necessarily, like when we saw the same level of volume back in March, tender rejections were over 12%. Now we're under 6%, which was pretty much where we hovered all of 2019. So spot rates, spot market activity is still very low because carriers are simply just gobbling up everything they can get their hands on right now, and it's keeping rates suppressed.
And I think shippers, every year it seems like they get, they forget some things that they learned, but they also sort of are gradually becoming more sophisticated, and we're seeing, or at least we're hearing about, I don't have the good fortune to move freight myself, but we're hearing that a lot of the largest, most sophisticated shippers are tendering mini bids, looking at certain markets, looking at where pricing or capacity may be in their favor to move freight kind of in almost like project-sized batches rather than sort of continuous, like steady awards in a way.
That's super, I think that's a really good technique for right now, because like you said, with the unemployment rate, nobody was predicting a drop in the unemployment rate. I think a lot of people were expecting it to go up. It drops. This recovery looks more and more like a V shape or some sort of like bounce off the bottom, natural disaster type recovery versus the traditional recessions, depressions that we've had in the past. So that being said, that means that 3 months from now, conditions are going to be entirely different. So anybody that's going out for annual bids right now, long-term bids, are potentially setting themselves up for failure in the future. And relationships are only going to get you so far, especially when you're talking about carriers that operate on 99, 101 ORs, meaning they're losing money on shipments right now or making a cent for every dollar that they ship. If they get a chance to go out to the spot market in 3 to 6 months and make, 100 times what they were making on their contract freight that they locked in right now, they're going to take that chance, because that means that that's their survival. It's no longer a question of, am I getting greedy or not? It's literally, I have to take this opportunity. So these shippers or brokers or whoever, that's managing this freight right now needs to keep in mind that the relationship will only work so far, especially when a lot of these carriers, especially after a soft 2019, were in survival mode already.
I think some of the larger shippers with a lot of leverage are maybe asking for longer contracts, trying to lock rates in lower. Maybe they're trying to kind of bluff their way in a sense into having lower rates for longer. But a lot of carriers or a lot of shippers, and I think this comes out in the mini bid strategy, they're kind of admitting that they don't have any visibility into future demand either.
Right.
They don't really know.
I think we can all get on that page right now. I mean, I myself didn't see us being at an 11,000 OTVI in June. That's we're at 2018 style volumes right now. 2019 style rates.
And at some point, those lines have to.
They will correct eventually. So whether I think the volumes are probably going to come down a little bit. Especially, we'll see how this June works out. Traditional peak season right now, as we ramp into July 4th. But again, is this going to be a regular year?
I just think psychologically, the fact that the narrative is now changed to not how bad is it going to get, but how quickly can this economy put people back to work is going to, that is a psychological narrative that should work powerfully in the carrier's favor, I would think.
You would think, but I know that there's shippers out there trying to take advantage of the moment, which is not the worst thing.
And by the way, one of the few sectors, or I shouldn't say one of the few sectors, but one of the sectors that did lose jobs or have a net loss of jobs was truck and transportation. So capacity is still coming out of the market, which has been that's been the story for over a year now.
Yeah, I mean, I think the question is how much capacity is it going to take to leave the market? Where's that inflection point? Again, carriers appear to be just accepting everything they can possibly manage right now. And how long does it last? Real quick, we've got a minute to go here. So we're actually seeing some of this play out in the reefer market or the produce market right now, because the produce season is kicking off. It's actually having a pretty steady year, and the harvest started on time, and they appear to be producing at an even pace right now. So a lot of reefer rejections are going up right now. Yeah. Where reefer volumes on the contracted side are going down. So there's an impact there more than likely as some of these carriers flood to the spot market and make 3 to 5
the mix shift. So we're going back from all grocery, no restaurants, swinging slightly back the other way, and that's definitely true. Grocers should see demand ease. But we wrote last month, we kind of went out on a limb and said it looks like reefer carriers are set up for actually a good year, against all the odds, and that I think is still the case.
Yeah, right on. Well, You know, these are weird times as usual and
Yeah.
unstable. So be sure to stay tuned for any future updates from On the Spot and FreightWaves.com.